Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show, the show dedicated to discovering the jewels of wisdom used for increasing ROI for REIs. That is, return on investment for real estate investors. I'm your host, Dan Breslin, and this is episode 107 with Omar Khan on investing in 100-plus unit multifamily deals. Omar comes from an institutional investing background. He's a CFA charter holder, which has given him a unique perspective on real estate and an unmatched skill set when it comes to underwriting deals and, more importantly, underwriting the team executing on those deals. Omar and I discussed the skill sets needed to succeed in both large commercial deals and also the smaller single-family deals like I do. A few also mentioned items include Omar's two favorite markets. As an aside, it was a previous guest on my show who initially piqued my attention about the Atlanta market, now one of my top performing markets at Diamond Equity. As you can probably guess, I am very interested in Omar's two favorite markets now as well. You have to check out the rest of the show if you want to know which two hot markets are mentioned. The only hint that I'll give is that I am already operating Diamond Equity in one of the two mentioned markets. Let's just get into it, shall we? All right, welcome to the REI Diamond Show, Mr. Omar Khan. How are you doing today?
I'm doing great, sir. It's a great honor to be on your show. Thank you for having me.
No doubt. I really appreciate it. So for listeners who don't already know who you are, can you give us a brief background of maybe how you ended up in real estate and then a brief synopsis of, how your business evolved to where it's at today?
Yep, I'd love to. So my family's always had real estate or commercial real estate holdings, not as their business, this was just their investments. So I kind of grew up around that. And just knowing that through the good times and the bad, the one thing that really helped my family out was the fact that they'd made good real estate investments. So I always kind of had that at the back of my mind. Personally, I graduated about more than a decade ago, and I started working in investment banking, equity research, the M&A work, that sort of work. So I have a lot of institutional finance background. I do a lot of stuff along those lines around asset management. And 3 years ago, when I moved to the U.S., I was looking to place my own money, some of my network's money specifically. And I just knew about all the great opportunities in the U.S. I connected with the right people, and now we run commercial multifamily and other transactions.
And when you say run commercial multifamily transactions, are you doing like value add kind of deals? What's your exit strategy, entry strategy, hold time? What's kind of like the philosophy behind the investments you're operating for the network?
Okay, so that's a great question. So primarily it's value add, but we're also looking at some self-storage and mobile home parks. Again, they're all in the value add sphere. Our entry is basically dictated by our exit strategy. So we always try to have two or three exit strategies. Number one is obviously, the refinance sold. The other part, what we also do is when we gather enough assets, we can sell these assets as part of a portfolio. So for us, before we even enter into a deal, we have to know very specifically what do we want to do in 3 to 5 years. 5 years is a typical exit point, but between 3 and 5 years is when we start looking at exiting from a profitable investment.
So these are not all based on one strategy, but you're looking at each of these investments individually and then exiting in 3 to 5 years. What price point, dollar amount, cap rate would be like the ideal deal that you personally are looking at, evaluating, et cetera, this week, the first week of July in 2018? What kind of appetite for deals are you working with right now?
So the average ticket size of the deals we have, say for the multifamily, because I'm going to talk about that more, is anywhere between $10 to about $25 million. That's the average size. Personally, having a finance background and doing all of that stuff for a little while, I personally feel the cap rate is a very abused metric. It's so easy to use that everybody uses it. And yeah, it's good to kind of understand it. We don't have a cap rate target. I'll give you an example. For instance, if we're getting a value add deal, by definition, not run very efficient. By definition is going to be very low. So as an example, if the cap rate is 3% for a deal, and with the potential that it can have a higher cap rate, only getting as an example deals with 6%. we'll keep missing these value add deals all day, every day. So I feel the cap rate is the most precise measure of evaluating the deal, and one has to look at both how much potential an asset has, plus how the assets fit in their portfolio.
So we have no basic cap rate target. That's good to know.
Yeah.
Do we have some favorite markets, Omar? Are there some specific places in the United States that you like, and why would you say those would be favorites?
So specifically, I'm targeting, for our group target, Southern United States. And more than anything else, we feel there's a couple of big macro economic factors. Number one is obviously the jobs. People are moving into a nicer climate, nicer jobs, the economy is moving. Number two, what we also feel is that the laws are more landlord friendly in Southern United States, primarily Texas and Florida, where we're very active. And I can tell you, having lived on both coasts and having lived in Canada, that, for instance, if you live on the coast or if you live in Canada, if a tenant moves into your building and they decide to not pay rent, best of luck trying to get them evicted. It is such a painful and arduous process. And once you've been burnt like that, you just don't want to go down this route. So Texas and Florida offer very landlord-friendly laws. They're very balanced, not landlord-friendly. They're very balanced between the landlord and the tenant. And that really helps us operationally running our assets at maximum efficiency.
Gotcha. So I'll give you my background a little bit. So we do somewhere in the neighborhood of 40 to 50 deals per month that are many wholesale deals. It's all single family residential. We have a few pieces of land or 2 flat, 3 flat, 4 unit buildings that come through, but mostly houses. I personally have, I think, 15 rental properties scattered throughout the markets that I'm in. I'm in Philadelphia, Atlanta, Tampa, Miami, and Chicago. So we have obviously resources and boots on the ground in each of those markets. Curious, I'm sure a lot of listeners are on the show, but how would I make this transition into that next piece, or where is it even a good idea for me, knowing my situation, that I have a good thing going? Should I be making a transition into, let's say, I don't know, a $5 million, $6 million, $7 million multifamily value add deal in Dallas, Texas?
Well, first of all, I would say that one should always be looking to diversify their portfolio. So if you have a good thing going, one should, you should try to continue that, because if you're really smart and good at that, don't let the gravy train stop. But I would ideally be saying that one should be looking at other areas, if nothing else, at least to develop their knowledge. And multifamily and a lot of commercial real estate, it's a team sport. So it's not a one-man operation. For instance, I don't do anything alone. I have partners. For instance, look, I'm a finance guy and I do all the legal, finance, due diligence, but I have a partner who's an engineer. I have a partner who is specifically related to marketing. I have partners who are specifically related to general contractor management and all of that kind of stuff. So it's a team sport. It's not a one-man show. So you have to basically start thinking about how to educate yourself the right way, because I think that's where it starts. And one of my pet peeves is that we have, because of the internet, we have so many of these gurus and mentors now that practically have no purpose teaching somebody because they haven't done any deals. But, when you look at some guy online, they have an Instagram page or Facebook page, and they've got a really cool looking video. They're just pumping out really, I personally think, wrong and bad content, which is not really helping the average investor out. So I would suggest that teaming up with the right people, understanding that it's a team sport, and then before making the move or deciding to invest somewhere, developing the right relationships backed by the right education.
Okay, that's really good, because for me, real estate's a team sport also. We have, obviously a team all throughout the country, and that's been instrumental for me. I've been blessed, Omar, to have great partners. We've had a few not so great partners come and go over the years, but for the most part, I mean, I have not had horror stories that, a lot of people have. I hear them tell in real estate. So you talk about getting the right people in line. Let's just say, for my example, okay, I like Florida. I'm kind of in Florida already. I identify an asset of $10 million. I think it's a value add, so maybe we'll just, skip over the underwriting part. For whatever reason, I decide I like that. Let's talk about my team. How would you go about instructing me to hop on a plane, make phone calls? Like, what would be the step-by-step, and which roles and positions should I have a piece of paper written out with a name next to or a blank spot before I consider actually funding and closing on that deal?
Okay, so there's a sexy part of the business, which everybody likes to talk about, which is raising capital and getting the financing and all of that stuff. But I can tell you that the sexy part of the business is only possible if you do all the unsexy part, which is basically the hard work, the day in and day out grind. So the day in and day out grind, number one, is let's assume you've identified a target market. And in our particular example in Florida, we are targeting Jacksonville and Tampa for multiple reasons, and we can go into that later. So what we now do is that I have a partner out of Miami. So now I've started reaching out to brokers, talking to property managers, to basically understand and develop my market knowledge. Because in every market, there are certain good areas and there are certain bad areas. And no area is good or bad because everything is dependent on your investment strategy, right? So some people, if you're a billionaire, as an example, you might only buy the newest, fanciest development project. But if you're not a billionaire, but you want to have a combination of income and capital appreciation, you might be looking at C or B type areas, right? So you have to understand what your investment strategy is, find the right kind of brokers, and then you have to talk to them professionally. This is where your education comes in. So as an example, if you reach out to the right broker and you say, hey, I want to find a cash flowing property in Jacksonville, I can assure you this broker is probably never even going to talk to you. These people are serious people, right? But if you say, reach out to a broker and say, I'm looking for a B and C type property, value at 10 to 15% below market rates, at, $7 to $15 million range, 100 plus units. What's a good time for us to talk? I can assure you, not only will that person be taking you seriously, now you can actually be talking in the right manner and in the right form with them. So now they know you're a serious player. Once you develop the broker relation, then immediately you should start asking for referrals on property management. Property management is, I personally think that's, again, not a glamorous part of the business, but that's where the rubber meets the road. So you can have the nicest asset with the best in the best market, but if you don't know how to run that asset properly, there's no way you're going to make money. And conversely, you could have a really mediocre asset in an okay market, but you've got a top-notch property management team. Man, like 9 out of 10 times you'll make a lot of money. So once you get referrals to property management, then there is no substitute, right? This is a business, a lot of this business is around shaking hands and kissing babies, for the lack of a better term. So you have to go to the market. You have to meet brokers. So as an example, like I was telling you earlier, my partner who's in Miami, because I'm in Dallas, my partner in the next 2 weeks is actually going up to Jacksonville for a couple of days. What is he going to do? He's already arranged meetings with all the 6 brokers that we've talked to, we talked to a lot more, but 6 are the brokers that we really liked. He's going to not only meet with them, he's going to tour properties with them. While he's touring properties, the 3 property management teams that we've identified, they will come along with us to give us their opinions. Okay, we kind of like this asset. We don't like this asset. This is what we can do. With the idea being that before we even decide to purchase anything, players in the market need to know that we're serious people. Because look, the way we look at it is, look, Dan, you worked really hard for your money, right? You know the sacrifices you've made to save every single dollar. But if you or anybody, for instance, me or anybody else, they go in blind, what do you think people are going to do? They're going to sell you the bad stuff that they can't sell to anybody else, and you're going to end up having all the bad assets in the market. So for this, a lot of times it's about developing relationships. After my partner goes in the next couple of weeks, in August, September, and every 4 weeks from then, I will be visiting those markets. And part of my visits to those markets will involve playing golf, going fishing, doing all of these things with the brokers and property managers. So once you have a personal relationship developed, then you start seeing that things start moving really fast. So initially there's a lot of work that you've got to do, but once you set the foundations correctly, man, then it's just plug and play. Boom, 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 boom. Then that's how it happens.
Gotcha. So I'm going to need a broker or multiple brokers, and then the property management seems to always be a critical piece. I have property managers cleaning up my mess in my portfolio. I buy not the best rental properties because of the channel of deals that I have coming through. I usually buy the problem properties from landlord because I care about getting a really, really good price and then dealing with the headaches. So my property management company is good and working through all that mess to stabilize the asset. I mean, obviously the broker is important, but would the property manager be even more important since you're married to this person for the 3 to 5 year term?
Yep. In fact, think about it this way. The broker is your best friend till you buy the property. Once you bought the property, the broker isn't even involved. The broker has other clients to deal with. But you're the one who has the property now because you bought it. And your property manager and you are in this together for at least 3 or 5 or however long years or however long many years you want to hold it. So the broker is really only at the start of the deal. They're a very important function of this entire process, but they're only really there for a very small portion of time. Your property manager is there for the 95% of the time in this whole deal cycle that you're going to actually be holding the thing.
Can you give me an example of, your partner in Miami going to Jacksonville is probably handling this. Have you had the opportunity to be present for some of these initial property manager team tours and things like that? Can you give me an example more of like maybe a stellar property manager and what that first impression was like during the property tour and what happened and what information they gave you that made you feel secure in them, and then maybe the results in that top-notch property manager that you would be giving me the example of, not just a fictitious one, but maybe this exact actual thing happened with you on a property manager.
Oh, yeah. Look, I'll give you an example of assets we've already done. I'm a very process-driven person. So, for instance, in one of the assets we acquired in San Antonio, before we even acquired that asset, when we were talking to the property management, we wanted to essentially know how many units do they manage in that submarket, how much experience do they have, what are the staff qualifications, then within their management agreement, what were the terms and fees, for instance, they were going to charge us, how much were we going to be responsible for, what are they responsible for, so clear delineation of duties, okay? Then we also wanted to know if things don't work out, how will we how will we terminate our agreement with the property manager? Then from a personal point of view, because I'm a finance guy, I wanted to know, how quickly do they close their books, their financials? Because as quickly as they close their financials, then I have to close my financial books. And then on top of that, I need to know what their capabilities are in terms of when we are actually acquiring the asset, which we did in San Antonio, 253 units. How are they going to go through the lease? What are the operational due diligence measures they're going to bring in? What kind of vendor relationships do they have? In our particular case, of the 3 people, because this was a value-add deal, of the 3 companies that we were interviewing, the one we eventually went for wasn't the cheapest one. In fact, they were, I think, on the higher end of the spectrum. But the reason why we went with them was because they had better construction management experience, and the quality of their reporting was top-notch. Because I don't mind paying more as long as somebody gives me more value. So in their particular case, they closed the books quicker. They had rules and processes and regulations for pretty much everything, and they gave us their manual. So that gave me a lot of comfort and, okay, we're not flying by the seat of our pants. And then they had actual experience within that submarket. They were managing more than 2,000 units, and they had completed value-add projects way quicker. But we could only really find that out after we toured multiple properties with them. We talked to their referrals, and then I basically told them, okay, show me what you're doing live. Not an example, live. Show me a report of a property that you did in the last 3 days. And that's what gave me a lot more comfort.
And you're almost 10% of their entire management portfolio, 253 units. What was the cost on that, and what was the cost, just percentage, simple? I'm sure there's a lot of other fees we couldn't quantify.
3.5%.
So 3.5% on gross. And then what was the other one that was lower cost that you chose this more expensive one?
I mean, that guy was going to do like 3%, and he said, look, if you give me more units, maybe we can go to 2.9. And look, I just didn't think they had their ducks in a row. And I think they were trying to compete more on price, whereas we were trying to figure people out on value. And we just felt the value that this other property manager offered us was a lot more. Because to be honest with you, look, a lot of people feel like you're optimizing for the highest return. And look, that is important. As a finance person, I can tell you that's really important. But what we're also optimizing for is peace of mind. Because what I don't want to do is basically hire somebody and then do their job for them.
Yeah, and one of the things, I mean, my life lesson, I'm 38 years old now, one of my own life lessons that over the last couple of years has come to the forefront, especially in hiring contractors, but within a lot of places in life, it's not all about price. I don't want to go to try to find the absolute lowest price if I got to, drive 15, 20 minutes further across town to save $8 or something like that. So
stepping
over pennies. Yeah. So the property manager on a value add deal, is this typically going to be the role who's going to handle turning over of units and processing through the actual value add, or is there an additional partner or person who's then responsible for more of the general contracting aspects of one of your example deals?
So we wanted to actually look for people who could handle the entire thing. Now, we do know that some of our partners, they have some of the guys that I know, they have their own general contractors or preferred contractors, and they prefer using them. In our particular case, we wanted to make sure that the property manager that we were hiring, we had no problem paying them a little more. But as long as it was one central party that was responsible for dealing with all property management related issues, not just management, but the turning around of units, repairing the units, rehabbing the units, all of that kind of stuff.
Perfect. Let's circle back a little bit in our conversation. You said that you've identified in Florida, Jacksonville and Tampa in Florida as both markets you like to invest in. Can you enlighten me as to why in that specific market, those two?
Well, yeah, number one is jobs. Really, you just can't get away from that. Jobs. The markets are growing at higher than the national average. Number two, or the reason is that, again, in the some markets that we're targeting, this is B and C type properties, there's a lot of pent up demand because in these particular, with all these people moving in, the average job is anywhere between $40,000 and $80,000. These are prime targets, or these are our prime tenants. And with the amount of stock that is in the market that is catering for these particular people, that's not enough to take care of the people that are coming into these markets and the people that are already there. So it's a demand and supply issue. And number three, what's the biggest issue there is just relatively speaking, relative to Texas, and Dallas, San Antonio, Houston, Austin, there is relatively less competition. So we can do more with less effort in the way we source deals.
So there's more competition for deals across Texas, Sunbelt area?
Oh, yeah, a lot, exponentially more. That doesn't mean Florida does. Look, that doesn't mean Jacksonville and Tampa doesn't have competition. They have a lot of competition. But I'm talking compare this to, say, a Dallas and a San Antonio, which is a completely different ballgame.
Okay, cool. So, Omar, you came from a finance background. You have a lot of big numbers and qualifications. What lessons, what skill sets had you developed walking that path that transferred quickly, or was this always the same path all the way along?
So some of the lessons and skills that transferred over from my earlier jobs were, number one, the fact that I developed a lot of good relationships with people who actually had money. Look, if you're in investment banking, if you're in equity research, M&A, on average, look, you're probably making a reasonable salary, so you have money to invest. Okay, so when I moved down to the U.S. 3 years ago, I actually had a network of people I could tap into. And I had pre-existing relationships with them, and they knew what my capabilities were, and they could kind of follow me on my journey. So it gave me a head start that I felt I wouldn't have had if I hadn't been exposed to that level of people and in those kinds of firms. And then my personal background with finance, working in institutional firms, it really greatly allowed me to accelerate my basically positioning in the market, because when I go talk to brokers, I actually know how to do underwriting better than brokers who've been doing it for 10 years because I've basically run the gamut. So when they tell me a specific number and say, well, if you're going to change that input, I can call them out and say, no, man, that doesn't work for X, Y, Z reason.
Was dealing with the high numbers. So for me, I'll have a little admission here. This is something I've seen as a shortcoming for me for a long time. Mm-hmm. I didn't grow up with money. The family didn't have much money. I kind of had to cut my teeth and carve my own way here in the real estate business. And early on, I remember it was like even my first retail fix and flip. It was a house I bought for $20,000, and I think I put $30,000 into it and sold it for like $85,000. I was always playing in like the penny stock, the lower price, scared of the big numbers is kind of my admission.
Dan, for a guy who's scared of big numbers, man, you really hit it out of the park on your first deal.
At least I don't think
you Well, you're being too hard on yourself, man. I wish I could buy a house for $20,000 and do what you did. I'd do it all day, every day.
I guess even now with the rental portfolio, as my listeners know, my goal is gentrification. I listen to the emerging markets theory, and I see where localized populations are moving to, if any. So in Philadelphia, we have South Philadelphia. It's basically Center City. It's downtown. And it's been, decimated back in the 60s and 70s with what happened with a lot of the inner cities in America. And in my viewpoint, there's a trend that's, going back in the other direction in favor of city life, city living, access to ideas, restaurants, culture, et cetera, where people want to live in cities. And you'll see in South Philadelphia and in Humboldt Park, Lincoln Park, it happened years ago in Chicago market. I think there's a Seminole Heights area in Tampa where that's taken place. A couple other areas, around the markets, the Beltline in Atlanta. These are really exciting places to be. And I like the idea of buying my assets that I do hold in those areas. I can buy them relatively cheap, less than $100,000 per house. And my goal is for those to obviously continue to appreciate. And in those neighborhoods, there's $500,000 and $600,000 properties that, at one point in time, not too distant past, they were selling for less than $100,000, and even some of them 10 and 15 and 20,000 if you go back 10 years, 15 years or so. However, that said, I deal with a lot of headaches on the front end when I'm owning those lower priced assets because it's hard to collect rent. The neighborhood still is challenged by crime. The neighborhood is still challenged by the condition of the block. It's still difficult to get renters and tenants in there at good prices. So it's a little bit of a holding game, and then as it gets better, obviously it improves. And then you take, on the other example where I recognize this fear of the bigger numbers, and you'll probably laugh because you're doing $10 and $20 million deals at this point, $5 million, whatever it is. I bought a property for $440,000. It was like a 3-unit, and it already appreciated, over $100,000 in like 14 months that I can take out. So the price went up, and it really went well, and the tenants are paying more on time. There's just less aggravation, less headache there than the properties I buy with the lower price point. But I know for a fact, Omar, that I am capable of raising the money. I'm capable of hopping on the plane. I'm capable of finding and taking down the deal. But it's probably my own limiting belief surrounded by the larger numbers, seemingly larger risk, and the deals that you are consummating and investing in, right now across the country. So that's something I've identified that I'm trying to work around. Maybe you would have some insight for me as to how I could get over that next hurdle and not feel like I'm putting it all on the line, or maybe I have to put it all on the line to step up to the next level and play, in the commercial multifamily space.
Dan, I think you're being too hard on yourself, man. If I could find deals for that appreciate that fast, that quickly, I'm in the run. I just keep doing what you're doing. But man, that's
Fair
a home
enough.
run right there. That's another home run. But
Yeah,
look, man, my basic belief is, I don't think anything we do or should do is done in isolation. Okay. So for instance, as an example, if you feel, if you feel like you're really good at raising money, as an example, because you have a track record, right? You provided so much value to so many people, not just in your business, but through your podcast. And then people trust you because you've actually proven that time in getting in. So maybe what you need to do is partner with the right people. And before you partner and before you actually even get into the game of, hey, I'll raise some money, and you get into that whole transactional aspect of the business, what I advise a lot of my investors also is, and I've lost some business because of this also, because people, they take time and all that kind of stuff, is that, it's like any other relationship in life, right? I mean, do you have a wife or a girlfriend or somebody?
Yeah,
right?
yeah.
Right? I mean, and chances are, the first 5 minutes you met your wife, you didn't propose to her, right?
No, not yet. Yeah, we're
right?
together, but it's still not even that.
Yeah, right? I mean, even the aspect of getting together took a little bit of time because you had to evaluate, hey, is this the right person that I want to spend the rest of my life with, or a considerable portion of my life with, right? Does this person's personality match out? Are our goals aligned? Do we look at the world somewhat similarly? How are we even looking at things? So a lot of those, it's like any other partnership, I feel, before even deciding to go into commercial multifamily or any bigger or smaller deal, I think the first question you should ask is, who are the people that I can partner up with? And why should I partner up with those people? Because a lot of times, seemingly really smart people or seemingly really successful people might not be a good fit for you because of a personality issue or a perspective issue. So before you would even go down the line of investing in commercial real estate, I would suggest trying to find the right partners who can maybe educate you. And, obviously they'll learn from you as well. It's obviously a two-way street. And once you have a little back and forth and you develop a good sort of relationship, then going from there. Because look, it's a bit like setting the foundations for your house, I personally believe. If you set the right sort of strong foundation, then you can build a really nice house on top of that foundation. But if you don't set the right foundation and your foundations are kind of weak, no matter how nice of a house you build on top of that, it'll just be a really shaky sort of a house, right? So that's the way I look at it.
Yeah, that makes sense for sure. Like we earlier had mentioned, the partners I've been blessed with, there's just no systematizing. It's like God places the right people in my life at the right time to help, expand the team. And perhaps for me, like you just said, keep doing what I'm doing. We're getting great results. Yeah. I've continued to dig down with what works. And over the years, there have been a lot of different things that came along. And I'm sure a lot of people listening right now can relate to that. The Airbnb is a popular one right now. Everybody's got the webinar. Everyone's getting $4,000 out of a $2,000 a month rental. And, a few years ago, you just name it. There's just the new latest shiny object in real estate that anyone can chase. But if I ask you, you're going to tell me the specific deals that you dug down and, to the exclusion of all others, you make that work. And for us, finding good deals on single family houses, whether we wholesale them or fix and flip them, or hold them as rentals. Single family's really been our niche. And if you ask somebody who's building new construction, they're doing that, and it's the easiest to build new construction because they do everything. They're not discovering work and renovation. So, the new construction person does not do the multifamily thing, does not, maybe at some point grow to larger deals and being able to scale up. But they don't do, the single family thing the way that we do it. So certainly getting good at and following a niche is one to continue staying focused. Yeah. Cool. I'm going to switch gears a little bit, Omar. I know that you have this institutional background, and I've always heard vaguely about, being able to approach family offices, and I've heard people throw around things like bringing in institutional mezzanine financing and other, larger dollar institutional investors. Is that just a fictitious myth that I've heard, or is this ability to target institutional investors, is that reality?
Look, it's not fictitious because people are doing it, number one, so it's not a myth. But I think people tend to, at least a lot of the internet and podcasts, people tend to make it sound like it's, hey, well, you just approach somebody and they're just going to shower you with millions of dollars, and that's not I wish it was, and then it'd make my life a lot easy, but that's not the case. A lot of these people, for instance, it's like the country club mentality, okay? We have to realize that, look, your qualifications matter. How you present yourself matter. But the biggest thing that really matters in these kind of, it's like any other thing, is relationships. And I'll give you an example. I have an ex-colleague of mine. He's from Toronto. We work together in asset management. And they're raising money for a private equity fund for South Asia, right? And it took the guy 18 months, and this guy has a background in this, 18 months to raise the first $10 million from an institutional investor. But hold on, it gets better. It took him 3 weeks to raise the next $20 million from the other family office. Why? Because as soon as they developed, it wasn't 3 weeks, it was 18 months plus 3 weeks of work. It just happened that they developed the right relationships along the way, and they kept meeting the right people, and they kept knocking on the right doors, and, they kept getting rejected, but they kept coming back, right? But a lot of this is not necessarily just a question of intellect, or just a question of, hey, how smart am I, or how good is my strategy? A lot of times, it's also knowing specifically what does this family office want. So as an example, if you have, say, a German family office that wants to invest in the U.S., but only wants to buy office buildings, you can have the greatest multifamily asset on the planet, and they're not even going to entertain that. It doesn't matter how good your returns are, because they have options. So specificity gets funding. The more specific you are, the more specifically you can target people who are looking for that particular thing, and then you can start having conversations. Because if it's just spray and pray, you just kind of spray everywhere. First of all, you develop a really bad reputation. Nobody takes you seriously. And even when the guy who is going to take you seriously, when he sees what you're doing, they're just going to be turned off by that kind of thing.
So each institutional investor, whether it's a family office or some other type of institutional investor, they're typically going to look at certain asset classes and stick to their lane, and that makes sense.
Yeah. And they have very specific mandates, right? So like I said, if a German family office or a European family office only wants to buy office buildings, it doesn't matter how good your multifamily deal is or how good your industrial deal is. They're not looking for that. Literally, unless it's like the head of the family office or something. In fact, most portfolio managers, they don't even have the authority. Even if they like your project, they can't fund it because their mandate doesn't allow them to do it.
Makes sense. So what's your day-to-day look like lately in the business, Omar? What do you spend your time doing in July 2018?
So what I spend my time doing is just talking to a lot of people on the phone, trying to look at a lot of deals with the market being hot. Look, we can enter into a lot of deals very easy now, hopefully, but we are very strict on hitting our particular numbers that we've outlined for ourselves. So now, for instance, earlier, if we were going through, say, 50 deals to find like the one deal, to say 50 deals to find the 3 deals that we're kind of interested in, we'll put them, LOI contract or LOI on, and then one of them will close on. Now we've got to look at 150 or 200 deals. But look, the idea there is you just have to keep doing this. This is like any other business. It's not a W-2 job. You have to keep doing this with the idea being, look, when the market goes the other way, all of the work that we've done, all of the foundations we've laid, then we'll be able to move quicker. So, hopefully the market turns one of these days. But till then, we have to stick to our criteria. We have to stick to our plan and let the chips fall where they fall.
Cool. So I want to ask you if you had any book recommendations, but maybe for two kinds of people. Maybe people like myself who have real estate background, have been successful doing this for a while. What would be like two advanced, maybe 1 or 2 advanced book recommendations? And then if you had 1 or 2 that you would give to somebody, maybe just getting started, maybe it was somebody from your institutional investor background who was saying, hey, Omar, I want to come over and do kind of what you do. So the book recommendations I'm looking for are 1 or 2 for like beginners and 1 or 2 for more advanced, but definitely maybe that have helped impact your real estate investing business.
So the book that two of the books that I'm going to recommend for beginners, they kind of apply to experts as well. I mean, because I keep reading them, but I don't think I'm an expert yet. But they're not real estate books. They are more books along the lines. So one is Black Swan. Black Swan is a really famous book by Nicholas Nassim Taleb. What it basically talks about is, how we keep hearing, it's 1,000 years, 1 in a 1,000-year event. But the damn event keeps happening every 8 years, right? So it's not a 1 in a 1,000-year event. It keeps happening every 8 or 10 years. So what it basically talks about is, how do we look at risk and how can we help the way we look at the world? Because, look, if you can cover the downside, which is like, if you can lose money, if you cover that and protect yourself there, the upside has a habit of taking care of itself, man. And then we're so blessed to live in the greatest economy on the planet. I mean, known to mankind. That really, look, if you don't lose money, you're going to make money. Okay, if you can't make money in the U.S., you really can't make money anywhere else in the world. I'll be very honest with you. Okay, this is the greatest economy on the planet. Number 1, hands down. So Black Swan by Nicholas Nassim Taleb. And there's another book called Thinking Fast and Slow. So that's been actually really helpful in telling me and helping me when I'm sort of negotiating, when I'm still learning. So what it basically talks about is behavioral economics. So what it basically talks about is, how we hear, this person, this is the way they should act. It doesn't talk about that. It talks about this is the way the person will act. So you take away the shoulds and you start realizing small little negotiation tactics, small little things that we can use to basically steer the conversation in the right way. So that's more for beginner / expert sort of, realm. Not a real estate book, but really helpful in real estate, right? And for a more advanced person, so if somebody already has a finance background, I would tell them to basically partner with a marketing person to basically understand the marketing aspect of business. Because one of the things I've realized with a lot of finance folks, including myself, is that we're so numbers driven that we don't realize that there's a whole world outside of numbers. And numbers are very important, but people aren't robots. You've got to connect with people the right way. And if people don't like you, they're never going to do business with you, right? And that's just the way it is. So I would tell them more than a marketing book. I would tell them to hook up with a really good marketer and basically try to make themselves talk less like a robot, because we just get used to, numbers, and that's not the only thing in life. And for a real estate book, I would highly suggest, this is a textbook, so it might be a little boring, but I would highly suggest reading this book. It's called Real Estate Finance and Investments, Risk and Opportunities. It's by Peter Linneman. He's, I think, the professor emeritus at the Wharton School. Great guy, great background. The book is slightly boring, but look, if you make your way through this book, trust me, 99.99% of the time, even experienced people will not be able to fool you.
Nice. I got The Black Swan. What were the other two titles? Would you mind mentioning one more time?
Thinking Fast and Slow by Daniel Kahneman and Amos Tversky.
Okay. And then it was Real Estate Finance
and Investments, Risk and Opportunities by Peter Linneman. I hope I'm saying the last name correctly.
That's fantastic. All three of these are now on my list. I really appreciate the suggestions there. Omar, if you could go back and share with your younger self, 18, 21, 22, maybe just getting out of college, the crown jewel of wisdom, what would that be?
I don't think I am qualified to offer crown jewels of wisdom yet in my life. Dan. I wish I was. But I would tell my younger self to, I don't know if I change anything, but I would tell my younger self to maybe stop partying that much, my 18-year-old self. But I don't know where that would get me, because I don't think my 18-year-old self would listen to me right now. So
yeah, I guess that's true.
Yeah, I don't think my 18-year-old would. In fact, they won't even listen to an old guy like myself. But I would tell them to have a bigger plan, and things work out in the end. I was, I'm the typical South Asian kid. I worked with, my parents were really cool. Unlike typical Asian parents, they weren't like axe to the grind, try to study. But I put a lot of pressure on myself. I got good grades. I did this. And everything was like an obstacle I had to overcome, right? Not in a bad way, in a good way. Like, get the grades in school, get the right kind of job, do my CFA, And I would just tell my younger self to, relax, have time, things work out. Keep your eye on the ball, but kind of chill out. Don't be so aggressive.
Nice. So if anybody listening wants to get some more information about you, do you have a website or contact information that you'd like to share, Omar?
So our website is boardwalkwealth.com. You can go there and register your name and email and tell us how you found out about us, and we'll put you on our mailing list. You can also email me at Omar, O-M-A-R, at boardwalkwealth, that's one word, Omar at boardwalkwealth.com.
Nice. Hey, Omar, I really appreciate you taking the time out and sharing your wisdom with me today. I've got pages and pages of notes here, as I usually do, so I thank you for coming on the show.
Hey, Dad, you just made me feel like a really smart guy by saying the last pages and pages of wisdom.
Oh, yeah. Absolutely. Thank you, my loyal listener, for checking out this episode of the REI Diamond Show. If you're interested in checking out the next episode pre-release before the email goes out, please subscribe on YouTube or one of the podcasting apps, including iTunes, Google Play, or Stitcher. Do you have investment capital on the sidelines? Maybe an old IRA from an old job sitting dormant? You should check out superchargedreturns.com. After you enter your email, I'll send you an audio on how to self-direct your IRA into real estate investments or other alternatives to the stock market. You'll also receive future emails after signing up about upcoming private mortgage investment opportunities, which have previously averaged 10% returns for investors. That site is superchargedreturns.com. And finally, if you have certain topics, questions you'd like to see discussed on a future episode, or if you have a guest suggestion or might like to become a guest on the show, you can contact me by clicking on the Contact Dan link at reidiamonds.com. I personally do monitor that contact request form, and you can also check out any profitable real estate deals I might have available in the markets I'm currently operating, including Philadelphia, Chicago, Atlanta, and Florida. Thank you once again for being a loyal listener of the REI Diamond Show. Dan Breslin here. I will catch you on the next episode.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.